We're going to welcome in Chart Trader for our Trader Talk segment, and he got involved in a trade this morning in the S&P futures. Unfortunately, it didn't go as well as we would have liked. Took a small loss on that one, but I'd love to get your take on what the setup was and what your overall takeaway is now, Brett. And but first and foremost, good morning.
Good morning, Jim.
So I walked the listeners in just a little bit on your trade. I know you jumped in shortly after the open, and I think it's fair to say that you were a little surprised by the action, that it was a little heavier than you would have thought. So now that that's said and done, let's talk about what you liked about the trade and what you learned post-trade.
Yeah, sure. So, I mean, it was a simple setup. When you see the market gapping up and opening at a key, very obvious resistance level, oftentimes you have orders that are lined up pre-market. They trigger when the bell hits, and you've got people who are selling into that resistance level. It's been my experience that you get an initial very sharp, sudden kick down in the first 10 minutes or so, and then an immediate retest of that high. And that was the setup that I went for. And just as I was watching it, you know, the way the orders were coming through, I just felt like there was a much more committed sense of supply coming in, and I just didn't like it. So I kind of tossed it away with about halfway to my stop, which ended up being the right decision. We're still under a bit of pressure at this point, but it was just looking for a very particular dynamic when you get a gap up opening at resistance, and it looks like there's just something more going on the offer.
I would agree with you, and I think when I take in terms of tone, and basically it's a little survey of the tone that I hear from our trading desk, maybe what's out there when you look at the market, and you got a stock like Netflix that is gapping higher. A lot of the fan favorites are trading higher, and just seems like the overall tone is set up for a rally. And then you get this, and I don't know what to make of this yet. I know there wasn't a particular catalyst unless you've seen something.
No, I just think that, you've got to listen to the market. It's a crowdsourced object that's highly complex and will have inflections, and when they happen, there doesn't need to necessarily be a single smoking gun catalyst, but you just need to be sensitive to it. Right now, I'm not sure whether this is necessarily a very important change, but it certainly is more significant in terms of the amount of supply coming in than I had assumed pre-market. So it's important to take note of it and to watch this evolve and see if it starts to turn into something that is more important. We start to see larger pattern structures that suggest people are coming in trying to buy the dip, and it's just not working out. Then you start to build up new supply that can come in on breakdowns, and we start to get a little bit of a bearish pattern. I don't know if that's going to happen, but I've kind of got my eye out for it at this point because, we did get a lot of good news lately. Really, when you take the last few weeks together, we have probably a lot of opportunity for there to be a little bit much in terms of weak hands leaning on the long side, so maybe some vulnerability. And if you have supply coming in that's a little bit unexpected, maybe a little bit programmatic, coming in at some important levels, then you can tip into a situation where people who are a little bit weaker-handed can cascade each other out. And we may be setting up for that. We may not. We've got to really see how the bid responds as the pattern evolves today. If we get some bearish patterns that try to trigger and are unable to follow through on the downside, then you still have that kind of plotting bid. And I think we still have this. Gavin and I did a segment on Monday that we're going to do on a weekly basis, the Sentiment and Flow Show, and we covered a lot of different measures that suggest that in my tape composition model process, one category has been really important here, which is the strong-handed longs that are flat. So people who have strong-handed portfolios who are underweight equities and are starting to maybe wake up to the realization that this isn't a bear market bounce and that we have another leg to the bull market underway, and maybe that we're going to see second half economic data that starts to pick up a bit. Maybe we get a trade deal with China, et cetera, et cetera, et cetera, and suddenly these guys all have to chase in. So I think you've got the possibility that there's a strong-handed bid that's always kind of creeping up underneath the market, And that's really what we need to watch out for when we start to get a little bit of a surprising level of supply like this. If we start to trace out some typical bearish patterns, things like descending triangles, where we set up a level, a range, a level, and then we start to break that level. If we don't see any follow-through, if we see that bid just kind of holding up and putting a floor underneath things, then I don't think that anything important has changed, and this is a meaningless pullback. But if we see some follow-through and patterns like that, then we may be starting the process of a little bit more of an important corrective leg.
All right. Does the probable lack of participation over the next couple of days throw a monkey wrench into that bias?
I think that we're near testing all-time highs, and we're kind of in the thick of earnings season, so I'm not sure that there's going to be quite as much holiday taking as maybe we might otherwise think. But, we'll have to see. I mean, one of the problems right now, I would say, more than having a holiday week is the range size. And I wonder if you could pull up my ETF daily notes on the Trader audio feed and scroll down to the very bottom chart.
Yeah, if you give me one moment, I can do that.
You got it. Because I think this is a really important piece of perspective. And I just kind of spontaneously put this together yesterday.
You want to look at today's note?
Today's notes, all the very bottom chart.
The SPY?
And something I posted. Something I posted yesterday afternoon as well. Just to kind of give you a sense of perspective, all I did was copy that red box and paste it in different areas around, just for easy visual comparison of what we're dealing with right now. And you can see every place I posted it in the little pastes, pretty much one daily bar subsumes that entire range everywhere. So just when you think about the process of trying to make money trading, particularly when you're looking at a top-down strategy, when you're playing index instruments, the ranges are the opportunity, and we have been just extremely narrow. And one of the problems with that is, and we talked about this last time, that we're getting a lot of good news gap-up patterns that sit at resistance and trace sideways for the entire day, and then we get another one the next day and another one the next day. So we get these little gap-up moves overnight and these tiny little ranges tracing along resistance. Now we're getting a little bit of selling pressure, which could start to stretch things out a bit, just like stretching a piece of elastic to where it can't set back quite as easily, and you get a few days of expanded ranges. But the point of this chart is really just to have some perspective of when you want to be aggressively trading and when you don't. Because the ranges are the opportunity. You really aren't going to get much opportunity in a market that's trading that's that narrow. So to go back to what I was saying just a moment ago about the holiday week, I don't think the holiday week is causing the narrow ranges. I think the narrow ranges are causing a decreasing level of participation because people stop participating in a market that's trading that narrow. And the people that do have to lever up, because you're talking about really small moves, and the only point in getting into a trade is to make some money. And to make some money in a really small move, you have to trade with more leverage. And if fewer traders are participating, and the traders that are participating are levering up, that's how you can sometimes get that next move back into an expanded range. It's just it's born of the same thing. So you get this narrow range. It's when I talk about there being a wormhole at one end of the volatility spectrum, that's kind of the idea. When people start to acclimate to a really low volatility environment, they tend to get more and more complacent, and you get this dynamic that I just described, where you have fewer participants, and those participants are levering up. So you get fewer orders sitting down the ladder to be able to absorb some of the supply when the stops are hit, so when levels are broken. So as you start to get that dynamic, people get more complacently leveraged in a market that really maybe has some air pockets and some thin spots. That's actually what drives the range expansion and drives the volatility. It doesn't need to be an event. It can just be this habituated state that the market works itself into. And I would say, regardless of where sentiment data is, I think that we have that type of dynamic going on here, even though I don't believe that we've got the ingredients for a major top. We maybe have the ingredients for a sudden and surprising range expansion. And you don't need to catch that first move. You don't need to catch this short. Hey, it's great if you're in this short right now, and we maybe have a test of exactly what I was talking about a few minutes ago with the way the NASDAQ has now traced out, let's say, the last 2 hours of action. You have a bit of a descending triangle in the NQs right now with a trigger around 76.82, If that extends down through 76.80 and you see 76.60 pretty quick, then you know we're starting that range expansion. And you know you're going to see some more elasticity in the tape. And we'll probably have more opportunities this afternoon and throughout the week if we start to get that kind of follow through. If this thing is plugged at 76.75 and it's right back at 76.90 2 or 3 minutes later, and then the volume starts to taper off, then you know you've got that bid that's just sitting underneath this market, protecting it from any kind of range expansion. So what I'm looking for as a trader and wanting to try to make money doing this rather than unnecessarily put risk in play that can just cost me money with no real upside, I'm looking for that dynamic. I want to see when we start to stretch that elastic out. We start to loosen up people's price expectations. We start to back people away from being so quick to buy into very tiny dips with big size, and we start to back people off, and people start to maybe appreciate risk a little bit more. We get a little bit more of a crowd dynamic. We start to expand things out, and people start to key off of each other. We get that serial correlation dynamic going on a bit. Then we have some much easier opportunities, and it's time to get a little bit more aggressive. Again, you don't need to catch this first short. This first short can signal to you what's happening. You don't need to catch it. You just need to see it. You need to be sensitive to the fact that it's maybe showing you something. But once that gets stretched out a bit, then you're aware that you're starting to loosen up the ranges a bit, and we get out of exactly that dynamic that I pointed out in that chart this morning, where all of the daily ranges are so bound up in these tiny, tiny little zones that there really isn't any opportunity to make money because there's no edges to the patterns. There's nothing that really ever takes off when it breaks out or breaks down. So we may have a little bit of a signal coming here to give us another road sign as to whether or not we're starting to loosen things up a bit. And, obviously I would really love to see that because that opens up two-way trading. We actually got a little bit of a sharp dip on Monday right off the bat. That was a little bit more aggressive than this one, and that opened up a big run to the upside in the NASDAQ. That opened up, we pounded down through the bottom of a range, and then we traced back up and broke out through the top of the range, and we were able to capitalize on that for about 50 points in the NASDAQ, and if I'd held on to it, it could have been about 110 points. But the point is, that stretched things out a bit, it opened up a big trade. If we stretch things out again a bit, it will open up another big trade. There's no need to force it until you have that little dynamic going on.
One thing I've noticed over the last week or so is that your day trading activity has picked up. More lower risk type intraday setups that may carry over into the next day. Is that something that you're doing, for lack of a better term, on purpose, engaging into more of that so as to help some of our listeners out or our followers out in that day trading aspect? Or are you seeing it as just normal standard operation for you?
I think that there's just been a little bit more patterned action.
Okay.
And I'm willing to take the patterns that are given to me. I really pride myself on not forcing things when there's not something there. So we've seen opportunities where we've had some small scalps. We've had some small opportunities. And it's been, I suppose, one of the most important things that I look for is a situation where I feel like I can very quickly get at least a little bit in the money. And then I have got this kind of skewed, asymmetric outcome distribution situation where I'm looking at either a very small loss or a scratch or a big win. And I like to put myself in that position over and over again, and I'm perfectly willing to take the very small loss or scratch as many times as necessary because the outcome distribution is skewed so that I really don't need to get that much to work for me to still make plenty of money. Rather than putting myself in a position where, and this is just, this is just a stylistic point. Different traders have different approaches. But that's my approach. I don't like to put myself in a situation where there's a large loss on the table or in the outcome distribution. So what I look for is patterns where I feel like there's a little bit of a trigger. We had a good example, I think it was late last week in the Dow, on a long trade in the Dow futures, where I really felt like there was no question we were going to head up through on intraday level. I think that it was on the 9th. We had a little bit of an ascending triangle after a dip, and really I thought there was no question we would definitely move up above 26,200, and I thought that there was a good chance we would not extend, but I knew that at that point I'd have my stop basically at break even. I'd be up 20 or 30 points in the money, and it could work itself out. But I knew that I would get that initial trigger. And then the question is, does it V-bottom? Does it head up another 150 points? Does it turn into a nice big win? So I think that I've picked up my activity a little bit simply because I've seen more situations pop up where the patterns feel like they're giving me an easy opportunity to put myself in that skewed outcome distribution.
All right. I'm going to shift gears a little bit and talk about the gold. And ironically enough, I drew that. I'm looking at the gold daily chart, so gold futures daily chart, and
Right.
I believe the front month is the front month now June.
Yeah.
Okay, good. That's what I have on there. So, all right. So I drew that blue line right there, and I did that because it's Florida blue. And then I remember that it's for you. And dude, it stopped right there. Hit the brakes right at that line. So
It's amazing.
yeah, I know you were probably looking for a flush. We didn't
Yes.
get it. Do you?
Still am.
Okay, so you're still looking for a flush, and you'd be.
I think there's going to be a flush. Put it that way.
Usually
no way
there
you
is.
can set that lineup.
Okay, so
there's no way you can set that lineup and stop one tick above it. We're one tick above it. One tick. It was 1275.3 back in what was that other low? January 1275.3. Right? We got 1275.4 today. So there is no way you are not going to get to 1275.2, and then we at least get to C. We're going to get to 1274 something, and we're at least going to get to C. There is no chance this thing is going to sit at 1275.4 and then walk back higher. No chance. That's just not how markets work. There's no way we're not going to at least do an inventory check. You have to check it out. Mm-hmm. Traders will have to check it out. They'll have to know what's really down there. You can see some orders, but you don't know what's really down there. It's such a clearly established line that there's no way the market doesn't at least go down there and say, hey, who's going to sell when I go down here? And I just think that there's no way that's not going to happen. So the question is it 1274 and then 1265 30 seconds later, or is it 1274 for half an hour, and then 1276, and then 1280, and then 1282? And if that second situation is the case, then I will probably chase in, and I'll probably feel pretty confident about putting a stop down even tighter than I planned, maybe 1270, and just say, you know what, I'll risk 10 points just for the possibility that this is at 1320 in a week, and we have gone and probed this level successfully, and we have seen that it is the trend base support. That this is the space station. We've started our move into orbit, and we've got a way station here around this 1275 area where we've got support, and then the next move is to break out above the multi-year range, which is what I believe ultimately is the point here. You've got a very clear, very long-term, very pronounced ascending bullish triangle that is sitting on that chart of the weekly and monthly, and this is a consolidation just underneath that, forming sort of that E leg. It's not impossible that this goes to 1250, but I think that we would start to see that now rather than see 1273 for half an hour and then 1290. It's not impossible. Right? That could happen, that you check underneath this, you move back up to 1290, and then you move back down and break it again. But I feel like, the way that this pattern sets up, and the way positioning is already sitting there, and the way that we've kind of got this renewed confidence in the cycle, I feel like there's a pretty strong chance that we're going to get something that's at least indicative about the pattern in terms of the way that it handles this zone. So I would like to see that sub 1275, watch the way the orders go through, get a sense of how pure this inventory check is, and then see if we're just moving right down and pressuring onto really strong hands that are just continuing to come up and accumulate this.
As far as positioning goes, when you look at the commitment of traders data, does it lean to the side of being underweight bulls in this case?
It's, I would say, inconclusive, but it's certainly not problematic.
Okay. And obviously nowhere near any type of extreme that would get you excited, though.
Nowhere near.
Okay. All right. So let's move on to crude oil. And headline data suggested somewhat of a bullish type move. We got a quick little, 20-cent knee-jerk higher. We've been really hanging around. We're flat now in crude. What's your overall sense of this market?
Well, so you have a little bit of a flip from last week in that you've got we said this, right? We talked about last week's data, and we made the point that you had this bearish number in crude but bullish number in all the products, and that you probably see that flip the next week. And this is that flip. So you get the bullish number come into crude, you get the big draw against the expectations of a build, but now suddenly you had expectations of a build in gasoline. You got the build. It's really not bad, actually. It's not like you got bad numbers on the products. But yeah, when you've got a production decline of almost 1% in the lower 48 states, which is basically, I kind of think of that as an indication of shale, what the shale guys are doing. They've actually pulled back production reasonably significantly, not super significantly. And you have the same thing going on out of OPEC. We keep getting these numbers where OPEC is basically underproducing what they were thinking they were going to be producing. So I think what you have is a really managed supply process here that's not necessarily indicative of a big boom in demand. You're getting the oil taken up, but not as much oil has been put in. It keeps a bullish framework in place, but yeah, you'd like to see, if you're sitting long oil, you'd like to see, when you see a dip in shale production and you see a kind of face value bullish result from the data, you'd like to see a little bit more strength out of this. And I think that that's probably just a little bit more of a nod to the fact that we have this massive confluence of technical resistance in place. You've got that Fibonacci level we looked at last week. You've got the underside touch of that long-term trend line. You've got the underside touch of that broken range from midway through last year. So you've got, I mean, this market has moved up a ton, and it's sitting right at a huge number of different important resistance levels. So I guess it shouldn't be that surprising that you see bullish pre-potency build up, but the market unable to really take advantage of it and extend. And the other thing that Gavin and I talked about on Monday is we have started to bust above that 500,000 net long contracts on large spec. Mm-hmm. So you are starting to see the kind of birth of a bit of a speculative position that opens up some vulnerability. So there's not like, I mean, when we talked a couple of weeks ago, we had a situation where I think it was at 430, and that was really 130 off the lows. That's maybe 150 away from where you'd expect to see it get to in a strong trend. So it really was, a jump of a significant amount in terms of spec long interest coming in that has powered this move. When you go from 59 to 64, that really does look like it was built of suddenly these guys at commodity firms coming in and going, we need to get spec long, because we're starting to see this, these underperforming supply numbers, and I think that that's probably where you've got right now. So you don't have that. The flowers bloomed to some extent in terms of the process of phase of trend, and you're at big technical resistance. Maybe it's time to see some kind of corrective or consolidative move to kind of shake some of that back out again. But I wouldn't expect to see, given this trend in really managed supply, it's probably going to be tough to really put a significant top in this right now.
Part of the reason why I asked is because of that vulnerability that you just outlined, and the fact that we had some, we'll call it bullish headline data, and the market didn't respond as such. Therefore, it seems as though we would probably be wanting to look for bearish setups in this.
Yeah, I mean, it may, I don't know how super vulnerable it is, but it's possible that, if we see, so you want to look for, again, you got to check back to the tape at that point and just watch how the orders are coming through it. If you start to get the sense that there are some big sellers who are sitting on top of it, that's a necessary piece of that puzzle. The inference about good data and a lack of bullish response to that data is an inference about big sellers in the tape, right? That's the point, is that people are using this as an opportunity to, if they've got supply, they need to get it off. They don't want to get it off by chasing the bid down and, slipping like crazy in terms of their execution price. They want to be able to sit there on the offer and just soak up day traders coming in and banging into the offer off of that number. And that's the inference. So that's what we would maybe assume around that 64.20 area. This is the May contract. You've got that supply. We would infer that supply is sitting there because it's not able to break above that, and it's doing an awful lot of supply cross there. So that's one sign. If it bangs against it a couple more times and it starts to peel off, then maybe you've got the possibility of starting to really get some more. Just like the question about the NASDAQ, and it's the exact same process, and this is why you've got to come back to short-term pattern resolution as one of your key ways to say, what type of tape is this? What type of tape are we seeing? With the NASDAQ, you had the descending triangle. You know what it did? It went down to just under 76.80, stopped, went right back up to 76.90. So we didn't get the downside follow through in the NASDAQ, or at least we haven't yet. May still be coming, and we may get another test of that area, and then we'll get a chance to see. But, crude oil, it's ultimately the same process. If you start to say, we've got a little bit of vulnerability. We've got some weak-handed exposure. We've got a little bit of a crowd kind of burbling on the long side. We're at big technical resistance. We see a good data signal, a failure to follow through. We get that inference about maybe there's some big supply coming in. Then the question is, when you start to taper off a bit, do you get those little signals that, there is a crowd leaning the wrong way? And that's ultimately what's necessary. The only move that matters here, if there's something that's going to happen that matters, would be down to maybe the 200-day on the continuous contract. You're talking about maybe 61 area, 60 area. That would be that kind of corrective target. And that would be interesting from the short side to be able to collect, 250 basis points after you start to see some signals that this is happening. So, here goes the NASDAQ again, headed back up to 7,700. So there's a bit sitting underneath the market on equities just to kind of keep that narrative going. But, yeah, I would think that if we start to get some signals in the tape for crude oil, I tried shorting it last week, ducked out for a scratch. Again, earlier this week, same basic result, and, kind of looking for the same process you were talking about. Now we're past this data. Maybe it gets a little bit easier if we start to see the right signals, but it's not really too active and interesting at this point as I just watch the orders going through crude oil right now. So we'll need to see some more confirmation. But there is the possibility. You've got one signal, which is good data, the inference of large sellers coming in, and you've got that 500-something thousand net spec long.
All right. Are there any other markets that you think we should highlight before we jump off?
So one thing I want to circle back around to, there was a question that was put into feedback. There's two things I want to circle around to. So one thing is the question was, we're back up near all-time highs with only around 100 new highs in the NYSE. That's pretty much like it was when we started falling last time, and I assume this means October of last year. What makes it different this time? So I wanted to address that really quickly because there is a difference this time. And the difference this time is that we're just a couple of months after seeing something that had full, mature bear market kind of sentiment at a low. And the last time around, we had that shakeout in February of last year, but the sentiment data that we got wasn't anything remotely crazy on the bear side. We did not see major portfolio managers just throw in the cycle towel. And we did see that in December. And so there's a huge difference. We're back up there now after going through that, let's call it a purging experience, a kind of a process of really capitulating out everything that was deadwood in this market, and all of the overripe fruit on the vine has been torched off of that vine, and so we're building back from that process. And I think that's definitely very different. When we were there in October, we were there after a stilted consolidation in February, where we really didn't make much headway on the downside. We changed the VIX landscape, but we didn't change the stock market pattern landscape tremendously, and we were coming off a massive bullish consensus in that January. But we were really kind of still in the process of saying, we're in a bullish uptrend from the 2016 lows, and there was a lot of dead matter to burn up by the time we came off of that October high. There was a lot of more important complacency that was baked into that tape. And this situation, you're right, the breadth is not fantastic for being in this sort of situation, but it's not terrible. And we have so much of, just like Larry Fink said yesterday, I think it was, and the fund manager survey that hit on Tuesday kind of reinforced the same idea that there's just a huge amount of money that has failed to wake up to the idea that we could be right now in the next leg of an expansion and bull market that has not come in to participate. And there's really this risk, and it's the same risk Larry Fink talked about. It's the risk of a kind of bubbling melt up a kind of, late 1990s style market. And the way the market is behaving right now certainly doesn't conflict with that idea. You might see those new highs really start to ramp as that money starts to come in off the sidelines because people are trailing their benchmarks by a mile. We know the fund manager data. We know they're not exposed. We know the hedge fund 3-month trailing beta on the HFRX. We know those guys are not exposed. If they've got too much leverage, it's because they've got it in bonds, because they're trying to make bonds return something like equities. And it's not the same thing as being, overweight equities and fervently bullish on the idea of a big bull market bloom. That's not there. So there's the risk that type of process starts right now, and that certainly wasn't the case in October, so that's a big difference. And one last point, which I thought was particularly interesting from the fund manager survey, is that, and again, this is like 200 to 250 large fund managers, and 13% of them, just 13% of them, think that global interest rates will move higher this year, and that is the lowest since 2012. And if you remember 2012, we were still basically mentally and psychologically across global markets, we were still in the global financial crisis for all intents and purposes, and it had turned into the will Europe fall apart crisis on a daily basis, and interest rates were nothing, and the expectations about interest rates were we're caught in this terrible situation. And 2013 came along, and it was the biggest, most productive year of the bull market. That's what happened next, and so that this is the type of level of assumptions about interest rates that we were in that context in 2012. And while we're at a very different stage of the cycle, and we've been through a lot more important developments, and we've had some Fed hikes, and we've had some coming out of QE here and there, to see us back in a situation where just more than 1 out of every 10 major fund managers thinks that interest rates can move higher this year is interesting, and it suggests a risk. It's the same risk. The same risk is that they're all wrong, and they're positioned according to that. And there's a decent chance that they're all wrong. And if that kind of you get this steepening yield curve, exposure to financials, global bank stocks is like the lowest in years right now, because people think there's no chance the yield curve can steepen. If you start to see growth data surprise to the upside, you get a trade deal with China, you get China stimulus stays in the system, the Fed stays on pause. We just saw CSX earnings boom through the roof. Like that's your they again, all segments for CSX are growing for a freight train, right? That's not the type of thing you see on the doorstep to a recession, and people are positioned for, if not a recession, then secular stagnation, and they're just sitting in that positioning right now. And eventually, it's just a vulnerability that just makes it, I think, a very different situation than we saw last October. So there's my extended answer to that question. I know it doesn't necessarily state something different about the 100 new highs on the NYSE today, but it underneath the surface, I think it's a very different environment.
All right. Excited about this earnings season coming up?
Am I excited about it?
Yeah.
Well, as excited as I ever am. I mean, it will be interesting to see the reactions, and it'll be interesting to see if there's any kind of signals in terms of really, really dramatically changed guidance. And it doesn't look like, we've already probably got enough of a sampling to say that that's not the case.
All right, Chart. Well, if that's all the markets that you want to talk about today, that's good for me. We've got some setups that are in the making, to say the least. So we'll be tuned in to see if you do indeed pull the trigger on any of these. I've been waiting for this gold trade for a long time, so I really, really hope that that it comes to fruition. We've been talking about this for like a year. It feels like.
You know what? Since February, the idea of this pullback. But you know what? It's doing what we wanted it to do. What would have been problematic is if it had 2 weeks ago just started to go through 1350. That would have been the situation where you don't want to see if you've got the process that I've decided to commit to here, and so at least it's playing into our hands. It's going to give us a signal. Now, if it melts to 1220, we're not going to be in that. I'm not going to catch that falling knife. I'm going to let it go to the trigger level we're looking for, watch it, understand whether or not it is the thing I think it is, and then act on that.
One last one for me. I'm going to pull up a copper chart.
That's actually a very interesting chart.
Okay, so May contract, that's the front month here, right? The May?
Yeah.
All right, good. Make sure I got this. Bear with me as I grab this.
Sure. And you're doing CME?
Yeah, it's CME copper. So it takes a minute
Okay.
for this to load up. So while I'm doing that, why don't you give me your overall assessment to it, and then I'll be able to catch up on the charts.
So yeah, this is another one Gavin and I spent some time in on Monday, and the idea basically is you see this, you'll see as it pops up, essentially what is kind of like a bullish flag pattern in terms of a range that we've built since basically late February. So kind of 2 months across in a narrow range, and over the course of that range, we have seen the commitment of traders data really dive in terms of the net long interest. The pop-up to start that range, we saw quite a bit of speculative long interest come in, and that has tapered down to basically nothing. And we're starting to see improving China data, and it opens up the possibility of a sharp bullish breakout out of that range because people no longer are positioned for that move. And if it starts to unfold, one could see the possibility that they come streaming in. Right now, you've got that $3 resistance area that's kind of held today, knocked it back down. I think that if we move back up through the spike highs that we put in today, we've got a bit of a tail there. If we eat that tail, then you'll start to see that spec interest rebuild, and you'll have a fresh breakout, which I think would be quite interesting as a signal. It's something that could actually bleed into other markets. If people see, transports performing well, something like CSX work out well, and copper breaking out, it's pretty tough to keep your positioning on interest rates as that it's impossible for interest rates to rise.
To me, this daily chart looks like that upward sloping triangle that you look for, and so therefore I was curious if you were at least sizing this one up as a potential long breakout candidate.
I am right now.
All right, well, there's 4 trades that you're eyeballing for potential. All right, well, then I'll definitely have to keep this one on the radar as well so that it doesn't take me so long to pull this one up. Usually what I do as a courtesy to the listeners because you're the most active of the in the futures and commodity space, I try to keep these charts handy so that when you get involved in a trade, people can watch if they're not participating in it, so they can at least see what's going on, and maybe it helps them as an input for their own individual trading. So I'll definitely have to keep the copper chart handy. All right.
Yeah, it's really too bad that there's no longer a good ETF on copper.
I know the ETF has got to be what, FCX, right?
Yeah, basically, and I think Gavin just did that this morning because
Yeah,
we
he
had the
did.
same
He
conversation.
did.
Yeah.
All right, chart trader. Well, I'm going to keep you on the line in case you do go ahead and go out with a trade today. As always, I learn quite a bit from you, so I always enjoy these conversations. So we'll wrap it up with that, and we'll be on the lookout for any new trades. Thanks a lot, Chart.
You got it. Thanks, Chip.
Okay.